guys, welcome back to Sierra TV. I'm Lorta Pata, your usual host with the most. So today we're continuing with basic accounting for business leaders. We are discussing balance sheet today. Alright, so just a disclaimer guys, this information is actually just meant for leaders who have never dealt with accounting before. They just need just a basic understanding. It is not technical. It's not for you to use to try and do your books for yourself. No, please hire a proper accountant to do your books for you, because the skill is actually quite technical by itself. Right, so let's get into it. Today we're discussing balance sheet, interpretation of the balance sheet. I'm just going to explain first what each area means, and then how can you actually know what questions to ask your accountant when they present to you what your management accounts or your financial statements, and you can ask, okay, what does this mean? Why are we here with this? Then they can be able to explain to you. Alright, so the balance sheet is actually divided into different sections, right? But with every section is different. There's the assets. The assets is basically the stuff that actually the business owns, and then there's the liabilities. The liabilities, you see the current and non-current liabilities. Those what the business owes. This is possibly your debt or whoever you're owing money. That's where it falls. And then there's the shareholders equity. This is where now how much the business is worth after all the liabilities have been paid. This is where now the business has put in whatever shareholders has put in money. That's where we check how much the business is worth, basically at the shareholders equity. All right, now let's start with the assets. When you look at the balance sheet, you'll see there's assets at the top. That's where it starts, right? Now with the assets, is divided into two. There's non-current assets, and then there's current assets. It normally starts with non-current assets. What are non-current assets? Non-current assets are also fixed assets, right? Remember what assets are? Assets are what the company owns. So an example of non-current assets or fixed assets are for example, your furniture or your laptops that you're using, your equipment for the office, and your furniture for the office. So that is your equipment, as well as the car that you're using. That'll be the that's also asset for the business, or whatever whatever assets that you will actually have for the business. That those are your assets. Now with fixed assets, there's tangible and non-tangible assets, right? The tangible assets will be, for instance, the ones that you can touch. These are your laptops, your iPads, your cameras. If you're actually a content creator like some of us, we do need cameras, we need lighting, and those will be part of our assets. Our laptops, as well as an accounting firm, we need laptops. Furniture, those that will be also our assets. The cars that we use for the business, those are assets. Now as a, for instance, a manufacturing company, the equipment that you use to manufacture whatever products that you're doing, that will be your equipment. That will be your assets as well. Now the non-tangible or intangible assets, what would those be? For instance, for us as an accounting firm, though, it would be the accounting softwares that we actually use for our clients. Those would be our intangible assets, as well as if you're a manufacturing company, there are some softwares that will be used to operate the machinery that you're using for some businesses. Of course, those softwares are intangible assets, right? For, let's say, maybe for, what can I give another example? For photographers, the software that you actually use to edit your pictures or whatever, or edit your videos, that is an intangible asset. Those are assets for the business, right? Now if you actually also look closely with within the balance sheet, you'll notice that there will be depreciation within the balance sheet, and then they'll give what you call a net book value for the assets. What does that mean? What it means is that as accountants, we always have to value your assets to the exact value that they are worth with over time, ever since you bought them, right? So if you've bought your asset, for example, if you bought your car in July, it is definitely not the same worth as it would be in July in December, right? For example, if you bought it for 150,000 in July, it is definitely not worth 150,000 in July. We have to account for that through what we call depreciation. All right, there's a percentage that we have to use on these assets assets for us to actually take the assets to the value that they are supposed to be at. It's given to us through the IFRS, so that one is not anything for you to worry about. It's a little bit technical, so just know that as accountants we have to value your assets to the exact more or less value that they are at when you've from the time that you've actually bought them. So you'll know most of the time you'll get questions such as from your accountant when they're doing your books yearly. They will ask you, please have your asset register. When they say your asset register, they will say they're asking for a list of your assets and when they were bought. They will even say, can we please have the time that you bought them, or the invoices of the time that you actually bought those assets. Then they will know what to, that's what they are trying to use it for, so that they can depreciate them and actually apply depreciation on them and give the exact value of the assets, right? So this is why in the balance sheet you will see the non-current assets with depreciation and a net book value. The net book value is the value of those assets at that particular time of the year that the financial statements or the management accounts are done. All right, I hope that is clear on the non-current assets. Non-current assets, like I said, they're also called fixed assets, right? Just fixed meaning they're here, they're not going anywhere, they're going to be with you for a while. Those are the non-current assets. And then the next part on the balance sheet, you'll see what you call current assets. What are current assets? Current assets are of the assets that the business will own for less than a year, or they change within less than a year. For example, an example of current assets would be stock. You know, when you've actually bought stock, those are assets for the business, but the value of the stock changes over time because it gets sold, it gets bought, it gets sold, so it's always changing. That's why we're saying they're current, because they're not going to remain the same with time. So it just keeps changing, it just keeps changing like that every single day, because you keep selling, you keep buying it all the time. As well as your cash at the bank, or your bank balance, or your cash in the office, that is also your current asset, because it actually changes over time, right? But it is your asset as well. Another asset of another current asset example would be what we call an accounts receivable. You will see there to be written accounts receivable. What are accounts receivables? Just to refresh your mind, I did mention what it was on our cash flow interpretation of the cash flow statement video. Accounts receivables are actually your debtors. Your debtors are your customers that you actually have a relationship with, that you give them a service and then they pay you later, where you have probably a 30 to 90 day payment plan or payment period with them. So maybe you've given them a service last month, but they still haven't paid you to date. That's where they'll be sitting until they pay that amount. So those are your assets that need to get paid with time. So they also fall under current assets, because they are not going to remain the same for long. Well, they shouldn't remain the same for too long. You should be following up the payments for you to actually get paid, right? And then we get into the next section. Now there's the assets and the non-current assets, right? The non-current assets and the current assets, the total of the two are actually going to give us total assets, right? You'll see on the balance sheet the total assets. That's just a total of the non-current assets plus the current assets. And then next on the balance sheet will be your liabilities. What are liabilities? Liabilities are just what the business owes. These are your debts, right? There will be current liabilities and non-current liabilities, also known as long-term liabilities. We'll start with the current liabilities. Your current liabilities, an example of your current liabilities will be such as your accounts payable. What are your accounts payable? These are your suppliers that you also have a relationship with them, that they can give you a service or they can give you a product, and you can pay them with between 30 days and 90 days. They'll be sitting there until you actually pay them, right? That's your liabilities, because you owe them money. And it's also, remember, current means for less than a year, so they should be sitting there for less than a year, and then you should be able to pay them off. But it keeps changing as well, right? What else would sit under current liabilities? Possibly your taxes, some taxes that you'll be owing, they'll be sitting over there as well until you actually pay those taxes up. Like for instance, your pay-as-you-earns, when you actually capture pay-as-you-earns, we'll be taking them to non-current to current liabilities until we actually pay those, because pay-as-you-earns normally are due within a month, but we would have deducted them from the employees before the next month that we actually have to pay them. So they'll be sitting there until they're paid off. That's just an example of a current liability. Non-current liabilities. What is an example of a non-current liability? That will be, for example, your long-term loans, like maybe your mortgage for the business or your business loan for the business. That's where they'll be sitting until those are paid, because those will probably last for more than a year. So that's where they will be sitting, the long-term liabilities, as well as known as non-current liabilities. And then within the balance sheet and then the total of current liabilities and long-term liabilities will be total liabilities within the balance sheet, right? And then after the liability section, there's the shareholders equity. Now this one actually shows what the business is worth. Now at the beginning of the business, most of the time the shareholders bring in the money, the capital that goes into the business. That's where it goes under shareholders equity. This amount will go up or down caused by what we call retained earnings, right? Now what are retained earnings? These are actually the profits that you would have made over the years, or the profits that you've actually made. They'll then be transferred to this part of the business, and it will actually either increase or decrease it. Now what would cause it to increase is that the profits have gone up, right? Or that you've made profits, so then it will increase your shareholders equity. Means the worth of the business now has increased because of that, right? Now what would cause it to go down? Normally with retained earnings as well, aka the profits from the business, sometimes you're gonna have to pay dividends. Sometimes the business needs to pay dividends to its shareholders. Now once the business has paid dividends to the shareholders, that means retained earnings will go down, and that means the shareholders equity also goes down because we have reduced the profits by paying the dividends, right? And then what else would cause it to go down? Well, maybe the business this year has actually made losses as opposed to profits. That will also cause the shareholders equity to go down, right? Now how do we actually measure the worth of the business in this aspect? We will then measure it by ensuring that after all the liabilities have been paid, now we will be sitting here and looking at, okay, now that all these liabilities have been paid, how much is the business worth? Looking at the shareholders equity as well as the assets of the business. That's basically it. That's how the interpretation of the balance sheet, that's exactly what it means. If you need to ask your accountant what you ask him, why has the shareholders equity gone down, they will tell you we've paid out dividends, or we've made a loss this year, or whatever that will have affected the shareholders equity. That's what will happen. As well as you should be able to notice why has your liabilities gone up. They will tell you maybe you are not paying your creditors on time, or you're just not paying them, period. So, or maybe your your creditors bills have gone up, so that will have caused various factors. So you need to be able to ask those questions. Why have my assets, why are they looking like they're reducing as well? Maybe you've disposed an asset, or maybe your stock value has gone down, or maybe your stocks haven't gone up, or whatever. There'll be various reasons of why certain things are happening in your balance sheet as compared to maybe the previous financial year, comparing it to this year, because you'll always ask questions based on what happened last year as opposed to what's happening on the current year. All right, so that's it for today. I hope it's clear. Please DM us if you have any questions. If you need any accounting or tax advisory services, or even personal finance training services, we're here for you. This is what we do. Educate. Anything money affects your money, your business money, your personal finances. This is what we're here for. Bye for now. I wish you all the best in everything you do.